Could the economic storm on the horizon blow away your investments? The winds of change are gusting and they're heralding a turbulent period for the global economy. We're standing on the precipice of a financial tempest, sparked by a surge in job cuts that began rearing its head in the latter part of 2023. This storm isn't just a passing squall. It's set to become a full-blown hurricane, likely raging on throughout 2024. The captains of industry, the CEOs, have unsheathed their swords, ready to make the tough calls, ready to sever the ties that bind their employees to their jobs. For those of you with a stake in the game, the savvy investors among us, it's a time of caution. It's a time to consider bolstering your defenses, raising your cash reserves, or shifting your focus to more secure options, like bonds. Why, you ask? Well, the first whisper of this storm came with the prospect of an initial Fed rate cut coming soon. Historically, this is a warning sign, a harbinger of the losses that portfolios often endure as we edge towards a recession. Now you might be thinking, but the market is booming, it's reaching all-time highs. And you'd be right, but don't be lulled into a false sense of security by the calm seas of the present. You see, beneath the surface, there's a key factor at play: desperation of CEOs. So don't let their smiling masked faces fool you on CNBC interviews. It's creeping into boardrooms across the country, seeping into the minds of CEOs as they grapple with the reality of the situation. They're not just fighting to keep their companies afloat. They're fighting to keep the earnings per share at the levels of yesteryears. But as the economic headwinds mount, as the pressure to maintain those earnings intensifies, the desperation grows. It's a dangerous cycle, one that puts Fortune 500 earnings at risk, one that threatens to topple the towering peaks of the stock market. So, despite all-time market highs, there's a clear message here. Don't be fooled by calm seas. The storm is brewing, and it's time to batten down the hatches. As investors, we need to turn our attention to the captains of these corporate ships, the CEOs. These individuals, often thought of as the embodiment of success and strategic acumen, are showing signs of desperation. How can we tell? The evidence is in the escalating number of layoffs across a wide range of sectors. Let's take a closer look. In the retail sector, companies like Nike, Etsy, and Dick's Sporting Goods have cut thousands of jobs in the past 3 months alone. The technology sector isn't immune either, with companies like Cisco, Google, Twilio, Broadcom, Qualtrics, and Spotify also wielding the axe. The bloodletting continues in the financial industry, with firms like State Street, Citi, Charles Schwab, and Wells Fargo announcing significant layoffs. Even sectors thought to be relatively immune due to their importance in our daily lives are feeling the sting. Healthcare companies like Centene Corporation, Elevance Health, Pfizer, and CVS Health have also begun to cut jobs. So what's driving these CEOs to such drastic measures? The answer lies in the earnings per share, or EPS. CEOs are under immense pressure to maintain, if not increase, the EPS levels from last year, despite the mounting economic headwinds. In a desperate bid to prop up these numbers, they're resorting to mass layoffs, putting the earnings of Fortune 500 companies at risk. This strategy, while appearing to make sense on the surface, is a short-term solution to a long-term problem. It's a red flag that these CEOs are struggling to navigate their corporate ships through stormy economic seas. In essence, these desperate measures are a red flag, a trumpet sounding an alarm for every investor. The captains of our corporate ships are in troubled waters, and it's time for us to reassess our investment strategies. But fear not, for every storm brings a silver lining, and every challenge presents an opportunity. Stay tuned as we delve deeper into the real impact of these job cuts and discuss the key question of CEO accountability in the next section. If you've made it this far, consider giving us a like and subscribe to support our work. We really appreciate it. But are these job cuts by CEOs beneficial, or are they a sign of poor management? This question begs for an answer as we delve into the real impact of these mass layoffs. The grim reality is that these cuts are not just numbers on a balance sheet. Each one represents a livelihood lost, a family's financial stability shaken. This social impact reverberates through communities, creating waves of economic uncertainty and distress. Are we witnessing a demonstration of sound fiscal strategy, or the desperate flailing of CEOs out of their depth? The answer isn't as straightforward as we'd like. While reducing overheads and streamlining operations can be legitimate strategies in a tough economy, the scale and frequency of these layoffs raise some red flags. A CEO's primary role is to steer the company through both smooth and turbulent waters. If they resort to mass layoffs as their first line of defense, it's fair to question their ability to manage the company effectively. Are these drastic cuts a sign of short-termism, a lack of foresight, or even incompetence? Are they a knee-jerk response to appease shareholders at the expense of employees' livelihoods? These are not rhetorical questions. They're an urgent call for greater scrutiny and accountability, and possibly even legislation. CEOs and their executive teams must be held accountable for their decisions, especially when those decisions result in widespread job losses. After all, a great leader is not just judged by the profits they generate, but also by the well-being of their workforce and the sustainability of their strategies. Moreover, these mass layoffs could be indicative of deeper systemic issues within these companies. Could these job cuts be a smokescreen, diverting attention away from potential mismanagement, a lack of innovation, or an inability to adapt to market changes? If so, this could have serious implications for the company's long-term viability and, by extension, its share price. It's time to redefine what social factor investing means and consider the social consequences of these layoffs. It's not just about the bottom line anymore. It's about the human cost and the ethical implications of these decisions. As investors, we need to look beyond the financial statements and dig deeper into the true impact of these job cuts and ask key questions. Is it valid to ban share buybacks for a certain period of time when CEOs execute mass layoffs? Should CEO compensation and stock options face audit scrutiny, holding period extensions and possibly clawbacks from prior years when layoffs are initiated? Should board seats for activist investors be declared automatically when a CEO cuts more than 3% of their workforce? Let's consider these ideas and please comment to tell us what you think. Should CEOs who lay off more than 3% of their workforce face questions for their own discharge as an ineffective CEO? That's the question we're grappling with today. It's a question that probes the heart of CEO accountability. Think about it. We've seen CEOs swing the axe, cutting thousands of jobs in the name of efficiency, of lean operations. Yet we can't help but ask, is it really efficiency? Or is it a desperate scramble to pad earnings per share figures? It's a question that shines a spotlight on potential mismanagement and incompetence at the top. If a CEO is forced to resort to mass layoffs, one has to wonder about their forecasting skills. Did they not see the trouble brewing on the horizon, or did they simply ignore the warning signs? Are they desperately driving share price via artificial EPS gains with cost cuts and share buybacks? It's a question that scrutinizes the staggering compensation packages that these CEOs receive. Bonuses, stock options, long-term incentives, these are often worth millions of dollars. Are these CEOs really worth that much if they're resorting to layoffs to make their numbers? Or are they, in fact, saving millions at the expense of their employees? It's a question that probes the CEO's talent management skills as well. After all, these CEOs are always touting their workplace engagement surveys, their rankings on lists of top workplaces. But if they're laying off staff left, right, and center, are they really managing talent well? Or are they, in fact, creating a culture of fear and uncertainty? And finally, it's a question that challenges the very essence of corporate social responsibility. If a CEO is willing to sacrifice jobs to boost the bottom line, what does that say about their commitment to their staff, their community, their society? It's a question of fairness, and it's a question that needs to be asked. It's a question that demands an answer, not just from the CEOs themselves, but from the investors who hold them accountable, from the regulators who oversee them, and from the society that grants them their license to operate. What can we, as investors, do in the face of this storm? The answer to this question may seem complex, but in essence, it is simple. When an economic storm is brewing, it is crucial to protect our investment portfolios. One viable strategy is to increase our liquidity. In other words, it's time to raise cash. While this may feel counterintuitive, especially when the market is reaching all-time highs, history has shown us that portfolio losses are the norm when the economy is on the brink of a recession. So it's essential to have cash on hand to weather the storm and potentially take advantage of lower prices when the storm subsides. Another approach is to allocate more of our portfolios to bonds. Bonds, particularly government and high-quality corporate bonds, tend to hold up better during economic downturns. They provide a steady income stream and can cushion the impact of falling stock prices. Perhaps the most important thing to remember is not to count on a soft landing. We all hope for one, of course. But if we look at the historical record, the Federal Reserve has rarely been able to engineer a soft landing following an economic boom. So, we must plan for the possibility of a hard landing, and especially in light of countless CEOs desperately sounding their trumpets with job cuts. If these captains of industry have no better opportunities for their talent than an unemployment line, every investor should question if these ships are possibly going down, and where regulators should ensure that the captains go down with their ships, instead of throwing the passengers overboard to save themselves. That's just what we think, but please tell us what you think. Comment below and share this video with a friend or colleague who could benefit from being Investorwise. And let's not forget the role of desperate CEOs in this scenario. Their actions, such as mass layoffs, are a clear sign of looming trouble. These red flags are waving, and we need to pay attention. As investors, we have a responsibility to make informed decisions. We need to question the actions of these CEOs and consider the broader social and economic impact of their decisions. This includes redefining social factor investing to include the social consequences of laying people off. In conclusion, the storm is upon us. It's time to act responsibly, raise cash, allocate more to bonds, and prepare for a potentially hard landing. We must not be lulled by the apparent calm before the storm or by promises of a soft landing. As the storm clouds gather, it's time to batten down the hatches and prepare for rough seas ahead.